So, in this show, I've been talking about this stealth market crash because it's been going on for literally months. And it's been masked, however, by the major indices. I mean, just for an example, just this year, the S&P is down 9%. But 49% of the names are down 20% or more from their 52-week high. And the carnage is even worse than that on the NASDAQ and the Russell 2000. This is why I think investor sentiment rates are so low, because in real life, investors are still pumping in tons of money into this market. Sure, it's obviously moving to different niches, but there's still buyers, even as they feel the pain. The question is, does that actually make them the smart money? I want to bring in Michael Lee and Scott Martin. The number one axiom in investing is buy low, sell high. So that means buy the dip. Scott, I mean, the retail investors are doing that during the middle of a meltdown. Does that make them the smart money?
At times it does, Charles, and it's easier said than done, certainly. I mean, psychologically, it always doesn't feel the best. In fact, some of the best trades I've made are ones that I had to kind of close my eyes and hit the button on. So I agree. I think on some of these big down days, we're getting a ton of volatility, both up and down these days. You got to pick up stocks that you like, maybe add to positions that are down, because these are long-term holds for most people that have good prospects going forward once we get through this malaise. Mike,
I know you have been bullish throughout this entire period, so I would assume that you like this approach.
Yeah, Charles, yes. And I would have to say, though, this kind of depends on what your expectations are, that if we have a big sell-off that you're going to make your money back or get a quick trade. I'd say day trading now is kind of as hard as it's ever been on the backs of one of the easiest periods to day trade ever. But, keep in mind, this is not the first Fed-led sell-off over the last decade. We had ones in 2018, 2016, 2015, 2014, 2013, 2011, 2010. Anybody who bought into those dips 12 to 18 months later was handsomely rewarded.
I want to talk about, some of these areas that have really caused, I think, investor sentiment to get hammered. One is SPACs. And, of course, they've underperformed the market by a mile. This month, 14 planned SPAC offerings worth $4 billion have been pulled. Mike, I actually love it. Now I'm hoping that maybe with stuff like this, that maybe somehow the SEC demands more transparency. I know the onus is always on buyer beware, but things like this, I think, have given the market a bad name.
Well, Charles, I've said it before, I'll say it again, I hate SPACs. And you can make these things so transparent, they're translucent. The fact of the matter is, the incentive for a SPAC is to do a deal, and the bulk of the time they overpay for those deals, which is not in the shareholders' interest. And SPACs that actually work out and people make money on, those are the exception, not the rule. I would, you want to steer clear of landmines, I'd steer clear of SPACs in any market environment.
Of course, there have been a lot of landmines, Scott, even without SPACs. Coming into the session, 44% of names on the NASDAQ composite were down 50% or more. Now, surely they don't all deserve that fate. So looking through these ashes, sifting through the carnage, where do you see some opportunity?
Yeah, there are a lot of dead bodies out there, Charles, and you can find some good ones, I think, to pick up here. I mean, two that we like right now are Workday and Zebra Technologies, two names we've talked about on the show before with you. Just, again, stocks that I think are oversold, stocks that do make money, stocks that have nice prospects built into recent earnings reports, and I think their earnings are going to be very good this quarter and next. And therefore, these are companies that are just down with the crowd. So therefore, you go into those ashes, as you mentioned, and pick up some stocks that have some real prospects here to grow going forward, and they'll be handsomely rewarded when the market bounces back.
Mike, what are you looking at?
So, Charles, next week we've got earnings from Facebook and Google, and wow, I would say from an ideological standpoint, these companies are pretty evil companies, but they're printing money left and right. We saw you saw with Apple and you saw with Microsoft that these megacaps, the reason why they are megacaps is their earnings power and how successful they've been. I don't think that changes. Facebook is down 23% from its September high. You could get in it. Well, I guess it's Meta now, but owning these names into earnings is probably not the worst idea.
Right.
And I'd say you want to be adding in this sort of ugly environment of multiple contraction. So as these companies continue to grow at double-digit growth rates in the top and bottom line, 2 or 3 years from now, when you have some multiple expansion, you've taken advantage of the earnings growth as well as the multiple expansion and more favorable market conditions.
Hey, Scott, I got just 20 seconds, but one or two names next week. Earnings, do you want to be in before the earnings report?
Yeah, two big ones, Charles. Google and Amazon. I mean, heavy weighted in the S&P and NASDAQ, of course, and they can save this market. So seeing how Amazon does, reflective of the consumer, how Google does, reflective of cloud, that is, and internet. You've got these two names that could actually come in here and really lift this market back off the ground.
Michael Lee and Scott Martin, two of the best. Thanks a lot. I really enjoyed that conversation. I hope people were taking notes. Folks, when we come back, my take on this.